Okay, we ready?
Born ready.
Doing some
You get loosened up.
what do you call these things, Patrick? What do you call
I have no idea what you call those.
Ladies and gentlemen, welcome to another episode of Rein It In. Today we got four major topics. I got four post-it notes in front of me, and they are very, very important. The first one is mortgage defaults. Are we seeing the types of mortgage defaults that everyone is expecting? We're going to talk about that. We're also going to talk about the rental demand and how the economic impacts, how it's impacting rental demand. Then we're going to talk about the foreign buyers ban and how that's going to impact investors. And finally, Patrick, we're going to talk about some economic risks, and we're going to connect the dots. In this episode of Rein It In, we're going to make it rain, Patrick.
Make it rain.
All right, Patrick, let's start by talking about mortgage defaults. I think every investor that kind of tracks the economic activity and everything that's happening has been asking themselves, when are we going to see these major mortgage defaults? Are we going to see a bunch of bankruptcies? Are we going to see a bunch of people defaulting on their mortgages? Are we going to see a repeat of what we saw in the great financial crisis, 2008? I think a lot of people are expecting it. Quite frankly, Patrick, people have been expecting this since the very beginning, when the government was handing out money left, right, and center, and people thought, no one's ever going to be able to pay this back. And we kind of have not seen it up until now, but are things changing? That's the question.
Well, everybody saw it, but the government, that is, or the Bank of Canada. That's a totally different rabbit hole to go down. But what drove this particular conversation for me was the recent headline that came out that actually said tens of thousands of Canadians could default on mortgages to rising mortgage rates, says the CEO of the Bank of Montreal. So what they're saying in behind the scenes is that they're preparing for a large number of people to be defaulting on the loans. Now, they look at it from two aspects. When you get behind the curtain, when you look behind the headline, of course, they're looking at it from, okay, we're going to be okay as a bank. We can handle a few tens of thousands. I don't know what that really means, but they can handle the blowback from a number of people defaulting on the mortgage. But when they look at it, they're actually anticipating 20,000 of the bank's borrowers potentially defaulting on it. And 2.5% of the bank's mortgage customers is kind of the numbers that they're throwing out there. And these are actually customers that already have, tend to have a lower credit rating and/or maybe they over leveraged a little bit. They don't have a lot of equity in the property. They went in a little bit light on their down payment. Some will say, well, what about CMHC and all that? Got it. But it doesn't mean that they won't default or potentially default on that loan. So they're anticipating it. It hasn't started to occur yet, although I think they're anticipating because they're getting some kind of signals that say this is coming.
Well, I'll tell you what I'm seeing in the market, Patrick. A couple things. First of all, I'm seeing something interesting in the market that I'll touch on in a second. But I want to say the article specifically says, and this is Scotiabank, that says 20,000 of its borrowers are vulnerable. So they're not saying 20,000 people are going to default. They're saying those people are vulnerable. And Patrick, like you actually said, the great majority of those people, I would assume, are, and this is my assumption, are probably on those kind of 5% down mortgages with CMHC, which, like you said, there is some protection there from CMHC. It doesn't mean I don't anticipate this triggering some type of market meltdown, just so we're very clear from that perspective. I certainly don't expect that. But what I am seeing is this, and I heard this firsthand, and I got to confirm this with a couple of our mortgage brokers, Patrick, but I heard firsthand that some people that are struggling with those mortgage payments, the bank is quietly re-amortizing them to 30, 35, and even up to 40 years in order to bring their payments down so people can afford it. I think that that's what a lot of people are going to do. I think that a lot of, these 20,000 vulnerable people, so to speak, are going to end up stretching out their amortization to lower their payments. And you know what? What a great solution. Because the bank, I'll tell you, the bank does not want to own these buildings. The bank is not in the real estate business. They're in the debt business. So if anyone is out there waiting for this kind of swath of mortgage defaults, I don't think you're going to see it. But that doesn't mean there's not going to be some great buying opportunities, Patrick, because that's different. Those two things are not equal. You don't have to have mortgage defaults to see great opportunities in the marketplace from my perspective.
You nailed it. The banks are in the debt business. And at the end of the day, we see these kind of headlines. We know they're clickbait. So it's important to kind of look at it and say, well, what does this whole thing even mean? And so I'm only looking at it through the lens called how do we see going forward with real estate investors? Because we've got this fundamental kind of conversation or problem that we face as real estate investors. How do we acquire real estate, with higher interest rates? We don't know what's going up. We don't know what's going down. We talk often about you have to look at what's happening regionally. But when you start to see this, although many are anticipating blood in the streets, I hate that term, but that's what they're anticipating. I don't think that's going to happen in our real estate world in Canada. That is, historically, we've had, really big recessions, and we haven't come to that, the great financial crisis being one of them. But at the end of the day, what it does is opens up opportunities for real estate investors who understand the strategies that can be used to help people that get in trouble, that have a problem. If we as real estate investors go in as problem solvers, it's a way different, or it's a far different way of looking at how to invest in real estate. And you do get to solve a problem. And I'm not suggesting that we're taking advantage. I would not suggest you take advantage of anybody. It's really going in there. These individuals have come up against problems, and it could be a job loss, one or two, or who knows what changed in a family household income, and they're behind the eight ball. They need to get out of that deal. And if you understand some of the strategies that you can use, you can be that problem solver.
Yeah. And actually, Patrick, at our upcoming R4 conference next month in February, we're going to talk about a lot of tactics and strategies and like real ways that investors can help these people solve these kinds of problems, real estate problems. And you know what? The fact is that these real estate problems are real, they exist. And as problem solvers, as investors that offer solutions, there's some real opportunity for a win-win on both sides of the aisle here, Patrick. And I think that that's what you're going to see a lot of. I specifically do not expect a lot of mortgage defaults. I think in Canada, we have a very robust banking system that, every investor knows how difficult it is to get a mortgage. So the point is that there's quite a bit of insulation there. And I think there is a certain number of people that are at risk, but I don't expect a big market meltdown from this.
There's a couple of things that we talk about, which is, we talk about recession, we talk about regions, we talk about real rates, interest rates, and we talk about real estate. So that's kind of it. So when we wrap the collective conversation around that, within all of what's happening right now is the opportunities. And those opportunities come, JG, from what we've talked about many times, which is the real estate cycle. And within the real estate cycle, just a few short months ago, everybody's a real estate genius at the boom part of the cycle, like at the peak of the boom part of the cycle. And now that things go into the slump, this is what a slump starts to look like. I mean, this is where there is, in fact, a lot of pain. This is where investors do kind of go sideways and stand off to the sidelines. And that's a different conversation. We'll get that. But it's where people get into trouble financially because they're over leveraged. Imagine lines of credit that all of a sudden have doubled or more in terms of payments. So they are stressed financially and they are going to need help. That's where investors are able to step in, help in those particular opportunities, because that's what a slump cycle looks like. And that's why so many sophisticated investors make all their money in this cycle.
100%. That wraps up mortgage defaults, Patrick. Moving on to the next topic, rental demand. This is actually a very important topic to us real estate investors because we can be as caught up as we want in interest rates and economics and all that various stuff. But at the end of the day, the rental demand is really what determines a lot of things in our portfolio. It's directly tied to our income. It's directly tied to our net operating income, therefore directly tied to our property values. What's happening with rental demand right now, given all the economic risks that are happening?
Okay, so let's put a few pieces of the puzzle together. First off, rental demand continues to increase. But here's some fundamentals of what makes that all happening. We've all heard the stories about, how many immigrants have come into the country, and, it's up around 750 or 850,000. I mean, it's a ridiculous amount of people that have come into the country and are continuing to come into the country. Now, we need that immigration, but of course, they come in and they need a place to live. So what do? They want to rent. So the rental demand continues to be quite strong, quite high, and I don't see that tapering off anytime soon. What's happening in amongst all of that is, of course, the rental rates are increasing. Now, we look at national numbers, and neither of us like national numbers because, of course, real estate is regional. I'll talk about that in just a minute. But when we talk about rental demand, there's another issue that is kind of not being talked about. There's two. One of which is more and more investors are pulling out. over the past couple of years, everybody was a real estate genius. We've shared that story many, many times. Everybody's getting rich. Now what's happening? We're into the slump cycle, the slump part of the real estate cycle, and all these investors are backing off, JG. They're going, I'm out. This game's too serious for me. It's costing me money. I'm at risk. All the rest of the stories that go with it. So guess what? Not as much rental inventory is coming onto the market. So from a real estate investor point of view, if you're a little bit sophisticated, have some techniques, some strategies, and really pay attention to what you're doing, you can be that rental housing provider. Now, the one piece that people aren't seeing is the relatedness of rents to interest rates. And when you look at what's happening and watch what's happened as interest rates have increased, so have rents. It's a kind of an interesting correlation. Rents are lagging, but at the speed of which we've raised rates, it's actually quite a phenomenal, we'll have that slide in here, it's quite a phenomenal correlation between the two, and it's easy to see exactly what's happening along that line. So what does that all mean? If interest rates go up, you're going to see another increase in rents, by the way. It's interesting that Tiff Macklem, our governor of the Bank of Canada, is talking about trying to control inflation. Yet as he continues to raise rates, what's happening? The cost of housing is going up on both the buy side and the rental side in terms of the cost of carrying a mortgage and the cost of rent. So it's an interesting phenomena that the Bank of Canada is facing. But as real estate investors, we get to look at this and say, okay, here is the opportunity, and here I was starting to show up.
I think you said a couple things there. The first one is that you're right. A lot of speculators, I won't even call them investors, Patrick. I think investors, the sophisticated investors, see the opportunity. The speculators are definitely getting washed out of the market. We talked about that probably 8 months ago, and we said, listen, there's going to be a huge washout of these speculators, which is going to create opportunity and rental demand, and that additional rental demand and increasing rent rates is part of that opportunity. So that's fantastic. What I will also add to that, Patrick, that I'm seeing in the trenches right now is, and we'll actually talk about this in a segment or two from now, because consumer confidence is low and business confidence is low right now, a lot of people are kind of holding their breath as it relates to rents. And what I mean by that is they're not moving. I'm not seeing nearly as much activity in the back half of 2022 as I saw in the front half of 2022. And that's because people are a little skittish right now. Their payments have gone up on their credit cards. Their payments have gone up on their line of credits. Everyone is kind of just holding and saying, listen, unless I have to move, I'm not going to move right now. And that has an effect. Now, what's happening is that because of the lack of supply in the rental markets, this just continues to increase rent rates, which is what we're seeing because of interest rates and because of this lack of supply. Rent rates are still going up, but you are definitely seeing, Patrick, I know in the areas where I invest in Ontario, we are definitely seeing less activity than we saw in the front half of 2022. I'm very curious to see what's going to happen in the spring of 2023. I think that will tell us a lot. I think we're going to see more of what we have been seeing. That's why I've dubbed this year Sleepy 23. I think a lot of people are just going to hang on to their hat and just ride out the next 6 to 12 months before they start making any major moves.
Well, I think that's a great point, but there's a couple things that we need to shine a light on here. First is, real estate is regional, as are rents. I'm going to give you some idea here. Atlantic Canada, the leader by a long shot of rental increases. This stat here, 31.8. This is, by the way, from Urbanation.
These are percentage increases, right, Patrick?
Yes, sorry. These are percentage
listen, Atlantic Canada, you used to be able to rent a place there for $96 a month. So of course their percentage increase is high. Let's be real here.
Point made, but another segment that we're going to have to do, well, I won't go down that path. So then in British Columbia, you're up 16%. Ontario, you're up 15.3%. Alberta, surprisingly, is only up 15%. Saskatchewan, 12.9%. Manitoba, 9.8%. And Quebec is up 6.3%. Now, these are all kind of, you see that these are significant increases, that have taken place, often driven by the cost of carrying as, rental housing providers. Costs are going up. There is inflation. There's the cost of mortgages going up, et cetera. So these are just literally being passed down. I think that one of the issues that you're seeing in Ontario, for example, any economy needs to take a breath. So I think you're experiencing, like, we've been on this roller coaster of like, we're going way up, but then it's like the economy just needs to catch its breath. Ontario is that way. We're not seeing that same slowdown. you're seeing it in British Columbia, the two high-priced market, Vancouver, Toronto, as an example. And then in Alberta or Saskatchewan or even Manitoba, they're just starting to ramp up. And why is that? Because interprovincial migration is driving people into those provinces because they got jobs, they can have affordability, and ultimately rents are starting to increase in those particular provinces. So that goes back to the regionality of real estate and what's happening on the rent side of the equation.
But I do want to say, Patrick, and I said this when prices started taking off as COVID was kind of like in doing its thing, prices started taking off. I was saying, you and I were both saying, listen, this is not good for real estate investors. And everybody was excited because everybody was a real estate genius. But I would much rather a market in equilibrium than a market that's out of balance the way it got, in terms of pricing. I'm watching this for rental demand because I don't want rental demand to outpace what real market rents are. I want just good, stable rental demand with good, stable rents that I could then cash flow my properties. If it goes up too much, I'm going to pay, and as investors, everyone watching this, you're going to pay the price later because rents will come back down. Everything always comes back in equilibrium. That's how the economics works. So it's important for people not to buy into this too much and to feed it too much. I want stability in real estate, not over the chart, over the moon raises.
Well, it goes back to what I just said. The correlation between interest rates is very interesting, and it works on its way up and it'll work on its way down. And ultimately, as rates come down, which they will, whether you think it's 23 or 2024, you can pretty much anticipate the rates coming back down. Will they go back to 2%? Not likely, but could they come down 0.5%? For sure. And it will, in fact, make a difference in the market. We saw that in British Columbia, particularly in the Vancouver market, back in, I think, around 216, 217. It's always lagging, by the way, which is good news for investors who are paying attention, because if you see that lag, you know what's coming and it gives you some time to relax or react. I don't think that you're going to see interest rates come down as quick as they went up, and not in this case. It was a pretty special time, so it was really easy to track those rental increases with those interest rates.
Did you say you expect rental interest rates to come down in 2033? Is that what I heard, or did you say 2023?
My intention was to say 2023 or 24, not 33. Could be. Maybe it is 33. Who knows?
Who knows? The bond yield is doing some interesting things again, which is, by the way, in case investors don't know, the fixed interest rates of mortgage companies is based on the 5-year bond yield, not necessarily the variable rate. Variable rate mortgages are based on the Bank of Canada, but not fixed rate mortgages. So just always interesting to say that, Patrick, because people seem to forget that.
Yeah. And I think there's a segment, I wasn't going to say it, but I'm going to say it. I think it's important, when we talk about Atlantic Canada, the East Coast, many people are going there because of affordability. And I mean, many people as investors are going there because of affordability versus the increasing rents, all very good. Just today, as a matter of fact, they announced that they're doing UBI, Universal Basic Income, and that will have an impact on what's going on in that world. And we're going to save that for another episode. But I wanted to put it on.
Who announced this? Atlantic Canada?
They approved it.
What? I did not see this. This is brand new information to me.
Breaking news.
Breaking news right here. Right here. I'll write it in. Breaking news. All right. I like it. All right, ladies and gentlemen, that wraps up our segment on rental demand. Very good news so far for investors, and we hope this stays in equilibrium. Don't go crazy, rental demand. Don't go crazy like prices went crazy 2 years ago. Keep it in equilibrium. Okay, moving on. All right, Patrick, next, our topic is on foreign buyers ban, the foreign buyers ban, which quite frankly, of all the topics we talked about in this episode of Rein It In, this is probably the one that people are most kind of attached to, and there's most energy around and a lot of emotion around it. But for you and I, it is by far the most boring topic. Foreign buyers ban. Patrick, what is this going to do? It is now official as of January 1st. What's new? What do people need to know?
There's really nothing to need to know unless you're a foreign buyer. And ultimately, it's much ado about nothing. It's politics over policy. There's nothing here of any substance. Foreign buyers is not going to change really anything. They were not a big part of the sector ever in the world of real estate and how it affected prices, which was, the general masses were kind of looking for somebody to blame, and seeing as the government's not going to put up their hand and go, well, I had something to do with it. No, they blame foreign buyers, and really it's less than 5% of the market, and that's at the extreme, and that's in two of the biggest markets being Toronto and Vancouver. So that's the first part. So some of the rules that are going to change, and oh, by the way, it's done in 2 years, just conveniently prior to the election. Oh my gosh, it just is so blatant. Anyways, we carry on. So ultimately, if you're a foreign buyer, you can't buy a single family, but you can buy, for example, a fourplex or a commercial unit. You can even buy an industrial. So what it does is it's limiting to what you can do in the single family space, but gives you lots of opportunity to park cash in Canada in the multifamily space. As well, international students. These are just a couple off the top. I don't want to spend a bunch of time on it, to be honest with you. But international students used to be able to buy, whatever, 13 million, no income, but they're students. They could go buy, 5 million, 4 million. There's all sorts of stories about international students buying multi-million single-family properties with no declared income, and they were able to do that. Now, that's changed $500,000. And then within CMAs and CAs, so within, and by the way, it doesn't qualify for recreational property or certain zones where you're, for example, on the beach would be one of those examples of that. They can still do that. So there's lots of opportunities for money to flow in. The easy workaround from that, JG, and I know you want to interrupt, but let me just finish this little segment, and I'll tell you the workaround is, if you got a uncle or a parent or somebody, friend, family member in Canada who is in fact a resident, there's nothing stopping you from funneling money through to them to make that purchase on your behalf, whatever the deal is in the back end. But ultimately, it's not going to be noticed. This is very, very much a political move, and that's what I got to say.
Well, and I think you're 100% right. And we've seen this before. It didn't really have any effect before. This has happened. This is not brand new, by the way. If someone's just kind of tuning in, it's like, oh, this foreign buyers ban is like brand new. This is new. No, this has been going on for years. It's been refined. It's been made a little tighter as of January 1st, 2023, but it's existed in BC and in Toronto for quite some time, which, by the way, has contributed to some markets. Like, for example, the Montreal market has exploded in the last couple of years. Part of that is because they couldn't put their money in Toronto, so they went to Montreal, and same with Ottawa, for example. But I want to explain why this is politics over policy, Patrick, because I think it's important for people who may not be kind of dialed in. The fact is that as a politician, you have constituents, you want to get elected. So you make promises that's going to appeal to the masses that, quite frankly, won't make a difference, but you want to get elected. And your job as a politician is to get elected. And as soon as you are elected, your next job, Patrick, is what? To get reelected.
Because if you don't fight for your love, what kind of love do you have?
So that's what this is all about, is just elections and getting reelected. And this is one of those policies. And there, by the way, there are so many others. And it doesn't make a meaningful impact. It certainly doesn't impact us as real estate investors. And it's nothing for us to really get all worried about, or for us investors to really get all jazzed up about. And I know a lot of people get very fired up about this foreign buyers ban. Quite frankly, I think it's just a big waste of energy. I think you should not be wasting your energy on this.
And it's interesting is that even some lawyers have looked at the way the legislation is written, and it's even open to interpretation. Secondly, is that you're subject to a $10,000 fine. Oh my gosh. When you're talking about millions of dollars worth of real estate, I'll take that $10,000 bet anytime. And because it's only 2 years, if it does go to court, because they do bust you, by the time it goes to court, by the time you're even in front of a judge, for example, it's well beyond that 2 years, and things have already changed anyway. So none of it will matter. So it's really is just politics.
Foreign buyers ban complete. We're not wasting any more time on this one.
Yeah, let's ban the conversation about foreign bans or something. Yeah. Anyways, that's about as witty as I can get.
All right, next on the list, Patrick, is the economic risk. Dun, dun, dun. Insert.
Ciao. Anyway, so
now there are some interesting stats coming out, and I know we're going to talk about economic risk. I know you want to connect the dots. You're dying to, but There are some interesting stats that came out, like the labor market turned out to be way stronger in December than they were anticipating. And there's also other statistics that are coming out stronger than anticipated. But there's these economic risks. So why don't you set this up for us, Patrick, so I can poke some holes in it?
Well, there is some economic risks. When you look at and start to connect the dots as investors, we have to look at what's behind the curtain. Back to your better news job wise, we have to question those numbers. And are there going to be revisions later this year? We're going to have to see, because one of the things that we have to shine a light on is 105,000 jobs, which is like 20x what they had forecast, and 105,000 jobs in Canada with 38 million people versus 225,000 jobs in the US with 380 million people. Sometimes things just don't add up, and you can't take it for face value. You got to say, let me just take a little bit closer look at these numbers. So I don't think anybody's trying to pull the wool over our eyes. It's just that how does 1,000 economists from the banks and the Bank of Canada and the government missed the mark of 105,000 jobs when I think they were forecasting like 15,000 or some ridiculously low number, relatively speaking.
I think, Patrick, I want to be an economist. I think I want to be an economist and a forecaster in the future, because you could be dead wrong and there's no repercussions. It's all cool. It's like, oh, something's wrong. It's kind of like being the weatherman. It's like, oh, I guess sorry, I was wrong. It did snow today.
Yeah, exactly. So that's one part of it. And behind the scenes, when we start looking at different data, you start to see what's kind of underneath of the surface. And it's one thing to look at the headlines, but there are certain things that if you don't connect the dots, as an investor, you may miss the opportunity. And the opportunity may be to get in the market, maybe to get out of the market, maybe to just how you approach your overall business of investing in real estate, JG. So some stats I want to share, I've got out in front of me here on my computer. But I'll put the dots and I'll connect all the dots in a minute. But here's some things that economists are sharing. 87% of Canadians believe they will soon enter will enter or are already in a recession, for example. Half of them shared that their spending is now outpacing their income. So their cost of living, we can look at in spending, or what are you buying, cars? What are you doing? No, their cost of living is outpacing their income. 22% say their ability to afford essentials has worsened over the past year. 48% of Canadians feel overwhelmed by their financial situation. Almost all Canadians surveyed admit they are worried about interest rates, 85%, and inflation, 94%. 27% of Canadians say mental health has worsened over the year. And I think that number is probably conservative, although the good news is that since we've come out of lockdowns, that number has improved. And 54% think it will take at least 2 years for inflation to return to normal levels. I, on the other hand, believe this is almost normal right now. I want to go to one more slide. A quarter of mortgage holders say that rates go much further. They will have to sell their homes. This goes back to the segment we opened with, which is opportunities for real estate investors who can, in fact, solve problems. 81% of Canadians still say there is a housing affordability crisis, and they use the word crisis. 2/3 are worried about making their mortgage payments. 20% of homeowners believe they can no longer afford the house they now own. Overbought the house, perhaps, when interest rates were lower. Not surprised by that stat, are you? 64% share they wanted to own a home, but can't afford to. That's an ongoing problem. And 85% of those renewing their mortgages in the next 12 months are concerned about the renewal and what it'll mean for their finances. So there's not a lot of good news there. Everybody's pretty bummed out.
Have you ever seen a survey like this that produces good news? Like even in the boom times?
No, that's not true. In the boom times, yeah, they throw some good news in there. People get excited. That's all part of the FOMO. How do you create FOMO if you don't push it out there, right? So we know that at the top of a cycle, you got to create FOMO, so you get some good news going out there.
You're the economist of the two of us. I mean, if you're smoking, I'm the bandit, or if you're smoking, I'm bandit, or if you're Batman and I'm Robin, whatever analogy you want to say. Of the two of us, you're more the economist than I am. Is there any credibility to this stuff, or is this just propaganda being put out by the news in order to get readers. Everything these days, Patrick, appears to be clickbait. I don't look at one damn YouTube video, article, headline, including all social media posts, which, by the way, I haven't been on social media in months. Been the best thing I've ever done. All of them is nothing but clickbait. Is this more clickbait?
Yeah, I guess somebody could argue that it is, but I think you have to look at a couple of things. I was recently on a podcast with Derek Lobo, who's a very, very accomplished investor and has done very, very well in his life. And he is one of the biggest sales guys and builders of multifamily units. He's done the biggest deals in Canada. But point of all of that is him and I had a similar conversation. And there is certainly a percentage of the population that, costs go up and it's inconvenient. It kind of makes you angry, but it doesn't change what you put on your table to eat. But there is a large part of that population that it does matter. So to the degree that these are stats that are being put out there, yeah, I think there's some real truth to them. If you're probably that lower 40% of the income table, whatever that might be, you're probably struggling. You're probably laying awake at night going, well, 5 years ago, or 3 years ago, I got a rate of 1.5 or 2.5, let's say 3%. Well, now, and I would totally bought into that whole mortgage because I could afford it. Nobody told me. And then, Tip Macklin looked into the camera and goes, rates aren't going anywhere for a very long time. Well, everybody's chilling, everybody's relaxing, and what happens? So a big curveball comes to a lot of individuals who were maybe on the edge to begin with. Well, this is putting them over the edge. So that's all to say this, that no, it's not good news, but I think that we have to take it for what it is. And I think there's some people that are struggling for sure.
Well, I agree with you, Patrick, because I paid $17 today for an A&W combo for a burger and a fry. And I was like, $17? This is absurd. $17 for a burger.
Okay, but that actually speaks to my point. For you, it pisses you off. It's annoying, but it doesn't change what you eat. For others, they're walking out of the store going, I'm not buying that. I can't afford to buy that. So that's the fundamental. And that's where these stats are built from, is that cohort of people, that demographic that are in that place. So it's all to say this. When we look at what's happening economically, we have to be able to connect all these dots. We look at the consumer confidence index, which is something that I really have followed for many, many years. And we see that although it's picked up a little bit in 2022, in 2023, it's actually come back down again. Now, that's, to be expected when you see the stats that I just shared with you. If we go to the next phase or the next conversation, it's about what's happening with small business. Because as much as we are hearing, lower interest rates, I can't afford to buy a house, in behind the scenes, where is the risk for investors? And we have to look at what is driving jobs, and that is business. Now, as much as we are getting mortgages, JG, you and I both have businesses, and although we've got mature businesses and we do okay, there's also those businesses that need to capitalize in order to grow. They may need to buy more equipment. They may need to look after the equipment they've got. So they're going to the bank and they're saying, I need to borrow money. Well, the cost of borrowing for businesses is in fact going up significantly and has gone up significantly. And what we're also starting to see is that insolvencies, although they're not as high as they were many years ago, let's say back into 2013, for example, the trend is up, and it's quite a steep trend, by the way. And as I say, it's not as bad as it's ever been, but it's definitely trending the wrong direction.
Let me jump in on the last two charts. I totally agree with you, by the way, about the interest rate that small businesses have to pay, because every small business owner has to run on credit to some degree. And like you said, Patrick, until you get very mature, and even when you are very mature, you're still borrowing money in order to grow your business, so on and so forth. The point is that high interest rates like this make business owners delay decisions. So like you and I are no different. I mean, right now, in one of my businesses, if I had to invest $30,000, $40,000, $50,000 into equipment, I would be saying, you know what, why don't we just pause on that? Why don't we just invest $5,000 or $10,000 instead of $50,000? And that has an economic ripple effect, I think, is the point you're trying to make. And I 100% agree with you. And I know right now, a lot of small business owners are making these decisions, and it will ripple through the economy. And listen, let's not kid ourselves, Patrick. This is what the Bank of Canada wants. The Bank of Canada wants to slow things down, if not crash it all together in order to get inflation under control. That's their narrative. And this is the way they're going to do it, by slowing it down, by raising all these interest rates. I think it's, that's their narrative, and that's what they're doing. Like, they know exactly what they're doing. Whether it's the right move, hey, that's debatable, but they're doing exactly what they said they're going to do.
Yeah, don't even get me going on that, because it's not going to slow down, and you can crash.
Oh, I want to get you going. I want to get you going.
They can crash the economy. It isn't going to change anything in terms of food prices and fuel prices, and the cost of housing isn't going to change a darn thing, because at the end of the day, there's still the cost of carrying that. The food and fuel costs are driven by oil. And as much as people are saying, well, we're going EV, JG, we're not going EV in a hurry. And in the meantime, Russia and India are doing deals on oil. It blows your mind what's going on in behind the scenes. All these sanctions that the world has put on Russia. Russia's just going, yeah, no problem. I'll hang out with India. I'll hang out with China. I'll do a whole different, I'll do business with a whole different group of countries, and see you later. And Saudi Arabia goes, hey, Russia, come on over here. We'll do some business, or China, whatever that might be. Anyways, the point is this. Is the cost of inflation overall is not going anywhere anytime soon. We may come down a little bit and it'll stick, and then it'll go back up. Some segments there'll be some deflationary. Everybody will see, look at the rates. Look at inflation's coming down. Yeah, okay. Yeah, we'll see what inflation does. The cost of oil drives everything at the end of the day. So we'll watch that. And back to small business. That's a concern for small business, or small and medium businesses. So back to what we were talking about, you've got small business confidence as low as consumer confidence. So now what are they doing? They're saying, well, to your point, I'm not going to borrow money. I can't afford to. I don't want to take the risk. And they're also saying, I had plans, sometime in 22. I'm thinking, things are looking pretty good. I can start to increase wages, keep staff, because guess what? Staff are hard to get. So I'm going to pay them a little bit more. I'll do it really well. We're doing okay. But guess what? They're backing off that. So the anticipated wage growth is actually coming down a little bit, and it's really at risk of slowing the economy down. We look at what the banks are saying. The banks are not anticipating a recession. Depends what bank you listen to. I still believe that there is a risk of recession, but I think it's going to be very neutral. I think it's just going to be really quiet, and things are going to slow down. I don't think we'll get into recession. However, Ontario may be at risk.
So you're on my page. You're going sleepy 23 as well.
Well, I'm going sleepy 23 in some sectors, and I think that it will be a sleepy 23 in that regard, because things are going to slow down. But inflation, inflation's not going to slow down. Housing will come off, but that's it.
Let's look at this chart. I want to look at this chart about business insolvencies. I find this fascinating, how business insolvencies literally dropped way down, like almost cut in half when the government started writing checks. When the government stopped writing checks, it started going back up. No, like if you put the CERB and all the various government money that's gone out because of COVID, if you overlapped it on there, I guarantee you it would be right when it dropped off and right when it picked back up. That's how much that floated those people in that time.
Well, that's a really great point, JG. And at the end of the day, when we look at SMEs, or what the CERB checks went out to, and the government support money that went out, it went out to all levels of business. And some of those are, entrepreneurs, solopreneurs that actually got checks. They had operating businesses, they got checks. And, so you saw that drop. Now, of course, the reality of what the economy is doing is starting to show up. And there's just certain sectors. When you look at businesses in the retail sector, they're not bragging about, life is going to be good. Their confidence has come down quite a lot in that world as well, in the retail space. There's a thing that we have to look at, and that is a lot of the jobs that have been created over the past 3 years have been public sector jobs. They've been non-productive jobs. It's administration. And as much as people say, well, the country shouldn't be run as a business, guess what? It is. Canada is actually a corporation. Very few people know that. Yes, we're a country, but we're a corporation, and we need to be run like a business. No different than you run your household. If you're spending more money than you've got coming in, then you better figure out how to cut costs or to bring more money in. But we're not doing that. We're actually not creating, manufacturing jobs. We're not feeding manufacturing. I think we're at historical lows on the manufacturing side. And I've said many times, we're importing more than we're exporting too often.
We have a one good month and everybody goes, woohoo.
Well, no, we need to do that on a regular basis. We need to drive revenue into this corporation, country, and then manage our costs and then create jobs that are actually producing goods and being productive, not administrative public sector jobs that are bureaucratic. So that's me. That's all I got.
Nice rant, Patrick. Nice rant. So one other thing I want to talk about
Hold on.
is
Let me wrap this. Let me bring this all together. Okay. Let me bring this together for investors to look at. The point is this for investors is these things are happening under the surface, and it's not to say get off the playing field. It's to pay attention to actually what's happening, because in all of this chaos, in all of this uncertainty is where the opportunities live. This goes back to what we've talked about before. Strategies have to change. Investment strategies have to change to fit the economic cycle, JG. You and I have coached it. We've taught it. REIN's taught it for 30 years. There's not a bad economy. There's just the wrong strategy and tactic to use within those economic conditions. We've got different provinces, different regions, different cities, all having different experiences economically, and that's what we got to tap into as investors. So what I want to say is, as much as this seems doom and gloomy on a grand scale and a human kind of what the hell's going on in this world, in our country, it does. But as investors, we have to get back to the basics of what will create a portfolio for us that's profitable and that we can grow.
And Patrick, that's exactly why we're having the R4 conference. REIN is hosting the R4 conference. We're going to talk about real estate. We're going to talk about rates. We're going to talk about regions, and we're going to talk about recession, because like you said, Patrick, real estate is regional and there are no bad economics. There are no bad tactics. You just have to combine the right tactic to the right economics in the right region at the right time. And that's what we're going to talk about at the upcoming R4 conference at the end of February.
Looking forward to it.
All right, Patrick, that wraps up our last topic, economic risks, done, complete. What a great episode of Rein It In. And I think you've outlined something very fascinating there at the end, which is there are incredible opportunities out there. REIN, yourself, myself, we've talked about this, how the economic cycle was changing. We announced this in 2022. We prepared investors for what was coming in 2023. Those that prepared are ready now for what's to come. Those that weren't listening should start listening, because the future is very bright, according to me.
Well done, JG, and I think it's bright as well.
I hope you've enjoyed this episode. Please like and subscribe. And if you've enjoyed this, please share it with someone that you know, because it's going to be incredibly valuable to them. Also, we'd love to hear from you, so please comment below.
If you're interested in learning about investing in real estate the right way, look at our Real Estate Investing in Canada program. 15 steps to successfully investing in real estate. Thousands of real estate investors have learned the right way to invest in real estate following those 15 steps. You're absolutely going to love that program. Take a look, click on the link in the description below.